Welcome to the best investment writing, your gateway to the minds of the world's most respected investors. Join us as they unveil the insights gleaned from their tireless research, providing you with invaluable perspectives to enhance your own investment journey.
All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hello, my name is Henry Neville. I run discretionary multi-asset funds at Man Group, which is a leading provider of traditional and alternative investment solutions. The Road Ahead, number 33, Against Apathy, published October 2024. A flaw with the traditional active versus passive debate was always the decisions you still had to make. Did you buy a bond tracker or an equity tracker? In what proportions, which subsegments, and so on. More recently, an attractive solution has been mooted. Buy an S&P 500 ETF, hold it, forget it. A recent meme that tickled me on the Olympics shooting events showed, on the one hand, a marksman kitted up to the nines, looking like something out of Avengers Assemble. The caption read, 4 monitors, 6 brokerage accounts, 15 stock forums, 40 to 50 trades a day, down 60% today. Next to this was Turkish silver medalist Yusuf Dikeç, looking admirably laid back in a plain white t-shirt and a pair of spectacles. And the caption, been dollar cost averaging into SPY for the past 12 years, has no idea what's happening in the markets because hasn't checked portfolio in a decade. There's a lot of wisdom to this. In those many layers built atop the lizard brain, we have become curiously attached to overcomplicating stuff. But, in my view, this drive against proactivity and intervention in investment has now gone too far. Here are 3 questions which capture the thrust. 1. Should you bother owning anything other than stocks? 2. Should you bother owning anything other than US stocks? 3. Should you bother trying to time stocks? Faced with these, there is the temptation to channel Maggie Thatcher responding to the overreaching arm of Jacques Delors. No, no, no. With apologies to Mrs. T for butchering that impression. But anyway, I'm on the other side, and here's why. Chapter 1. Should you bother owning anything but stocks? Yes, but case for the prosecution first. Over the very long term, stocks have returned about 10% per annum. By my reckoning, only 2 major asset classes have done more, trend on 11% and private equity on 14%. And both have disclaimers attached, not least the wide dispersion between naive and sophisticated actors and the difficulty of judging between the two. Gold's long-term compound annual growth rate is around 8%. US dollar credit is 7%, 10-year US Treasuries 5%, USD cash 3%. In short, in terms of native, that is, unlevered returns, not much can lay a glove on stocks. Here are a couple of lines of defense that, personally, I find persuasive. First, when I talk about very long term, I'm running numbers back 100 years, give or take. At some point, you've claimed to be a long-term investor. But, be honest, are you really? Some grave news. In 100 years, you will be dead. And, even while alive, can you really wait even 10 years? Looking back 10 years from December 1937, the US stock market was down 40% in nominal price terms. At the start of September 1946, it was minus 2%. In August 1982, it was minus 7%. As recently as August 2011, it was minus 5%. In other words, your lived experience, even over long time periods, of how stocks behave can be very different from the plus 180% return over the last 10 years you find yourself looking back on today. Moreover, in some of the worst years for stocks, I'd surmise your time horizon wasn't 10 years. It may not have even been 10 months. And that pain was such that you were likely wildly grateful for some asset class diversification. Since 1800, there have been 26 calendar years where stocks were down 10% or more. On average, in those years, the drawdown of a 60-40 portfolio was half the drawdown of equity only. Over the full 223-year period, 100% equity gave you an annualized return of 8.7%. 60-40 was 7.5%. So there has been a performance drag, but as discussed in a prior note, 90% of the time, the best days for risk assets come within 12 months of the worst days. See the road ahead, number 27, on pain. It is worth trying to negate the potential of you doing something stupid when your practical time horizon has been dramatically shortened by acute pain. Volatility has real-world effects, in other words. Second line of defense, if you can use leverage, logically, you should buy the highest Sharpe portfolio and scale to your required return. And 100% equity is not the highest Sharpe portfolio. I'm fully aware that's not as simple as it sounds. Mandate restrictions, as well as operational concerns around cash efficiency in a higher rate world, set limits on the extent to which some investors can pursue this. If that's you, skip to the next section. Otherwise, consider with me the fitted distribution of monthly returns over the past 100 years to two portfolios. One, 100% equity. One, 30% equity, 60% bonds, 60% alternatives. In other words, the latter is 1.5 times levered. I choose this ratio somewhat flippantly as the asset allocation most likely to bequeath your sprog $1 million. As set out in a prior note, see the road ahead number 12, how to leave your child $1 million. The diversified and levered portfolio has a slightly higher return in totality at 11.3% versus 10% for 100% equity. But simultaneously, it has less than half the kurtosis in its distribution, 8 plays 18. To you and me, that just means it has fewer extreme outcomes. Thus, both its volatility and drawdown are around half that of pure stocks. The note of caution is that if you are levered at the portfolio level, asset class diversification is vital, and more so than just diversifying equities with bonds. Indeed, and back to our discussion on equity versus 60-40 over the last 200 calendar years, 2022 was a notable outlier and a possible portent in that the 60-40 drawdown was almost the same as the equity trough. Negative stock-bond correlation is not a given, as I've repeatedly stressed in prior notes. So take this as your reminder that leverage and risk are not synonymous, but also, if you are using leverage, the importance of true asset class diversification also gets levered. Chapter 2. Should you bother owning anything but US stocks? Yes. Over the very long run, even taking into account currency returns, a US and equal weight global equity portfolio have returned almost exactly the same per annum at 10%. Moreover, they have done so with similar levels of risk. However, a shift has occurred in the past 2 decades. Observe the calendar year performance differentials between US and global before and after the global financial crisis. Before, it was 50-50 on whether you were better off in global or US equities. After, it's been more than 80-20 in favour of the US. And worth saying that this kind of persistence of outperformance is not like flipping a coin, whereby you might have had 9 heads in a row, but the odds of another on your 10th toss are still 50-50. Imbalances build up in these relative stock returns, and in my view, the risk of them tipping over is elevated. The US relative to other regions is a big sector bet on tech, itself a segment which has run persistent outperformance in recent years. It therefore trades at or near record valuation premiums compared with other geographies. Take the UK comparison as an example. The current difference between the prospective PEs is over 9 points, the biggest gap since the IBES data begins in 1988. The pre-2017 average spread was 3 points. Post-2017, it has been 6. But whichever way you cut it, the current premium is large. Now, the US is 40% tech and communication services and 4% energy. The UK has 1/10 of the tech weight and triple the energy allocation. That's important because both of these sectors have cyclical aspects. Looking at all years back to 1999, it is true that tech tops the GICS league table more times than any other sector, 7. But it regularly foots it as well. Indeed, it has been in the bottom 3 on 9 occasions, also a record. Meanwhile, energy is second place in terms of trophies won, 6. Both tech and energy have high levels of implicit leverage. Energy via operational gearing from a weighting towards fixed costs, and tech via the long duration implicit in product which is both complex and far horizon. There is at least some chance that AI follows Amara's law, and then you'd expect some of the valuation gap to close, possibly quite rapidly. There's already been a shot across the bows in the form of 2022. While US stocks fell 20%, the UK rose 5%. Regional diversification within equities is one way to protect against sector rotation, the risk of which is, in my view, heightened. Chapter 3. Should you bother trying to time stocks? Yes, but. I'm most hesitant on this one. However, if you're with me on the first 2 questions, you now have a portfolio with some other assets in it. Should you flex that ratio based on market conditions? The hesitation comes when you look at any long-term equity performance chart and divide it, either by eye or systematically, into bull and bear markets. The former dwarf the latter both in time and magnitude. It is hard to come up with any definition which gets you much below 80% in terms of the portion of time that is bovine. Do you really want to stand in the way of that? Meanwhile, bear markets regularly come as the bedfellow of a black swan. Think World War II, the Nifty 50 crash, Black Monday, .com, GFC, COVID, and so on, rather than the gradual deterioration in fundamentals that you find in the textbook, which is harder to predict. That being said, is it the black swan which leads to the deterioration in fundamentals, or the deterioration in fundamentals which provokes the black swan? It's an open question, in my view. But the temptation remains, and that's because the potential rewards are very large. $100 invested in the US stock market in July 1926 is worth $1.1 million today if you had bought and held. However, if you had ninjaed your way out of the 65 days through that period where the market was down 5% or more, you'd be sitting on $112 million. Never work again kind of money. The knife cuts both ways. If you'd gone wrong and instead had been out for the 60 days where stocks were up 5% or more, your so-called bounty would be just $19,000. It's Volkswagen Polo kind of money. While the potential rewards for good market timing are high, the potential costs for doing it badly are also elevated. Where I come down is the old adage of all things in moderation, including moderation. Most of the time, take your strategic asset allocation, buy, hold, forget. At extremes, however, do something. What do I mean by extremes? Well, there's no silver bullet, and if there was, I probably wouldn't tell you. But here are 2 things that help a bit. First, think about the market regimes where stocks have historically performed poorly. I discussed this at length in a previous note, see The Road Ahead, number 26, Regime-Based Investing. There are 3 regime states where you want to be out of equities: high and rising inflation, recession, and bear steepenings of the yield curve. On my definitions, over the past 100 years, there have been 9 episodes of high and rising inflation, 16 recessions, and 13 bear steepenings. The real CAGR for US stocks in these 3 states have been, respectively, -8%, -6%, and -5%, compared with +7% for normal times. The negative hit rates for the same are 78%, 50%, and 69%, with that for recession flattered by the fact that the stock recovery generally begins, and is most violent, in the late part of the downturn. Now, all this still leaves you with the problem of predicting regime change, which is no mean feat, but in my view, it's more intelligible than trying to think about drawdowns in isolation. And second thing, which helps a bit,
have a dashboard of financial data which is varied, discrete, and consistent. Varied in that you're not just looking at valuation metrics or just positioning data or just growth indicators, but seeking to cover the full range of lenses that practitioners prescribe. Discrete in that you're limiting their number. In a world where anyone with a Bloomberg terminal or even an internet connection has access to more data than they could usefully do anything with, filtration has become a key competency for investors. Otherwise, you risk going mad, lost in the data forest. And consistent as an antidote to getting led astray by every new broker email with that shiny new Sharp 2 indicator. Of course, everything loses efficacy at some point, but in the meanwhile, look at the same things and look at them regularly. In the written paper, which you can find along with the other pieces I've referenced on the Man Group website, I give a grid of my 20 desert island indicators. This is not a format Radio 4 are likely to pivot to anytime soon, so I won't read them all out here. Go check out the original if your curiosity has been piqued. But the bottom line is that, to my subjective judgment, we are currently on 8 red, 11 amber, 1 green. Red equals bad time for stocks, amber medium, green good. Bad extremes are lots of red, good extremes are lots of green. Those are the times for market timing, under and overweight equities, respectively. Right now, I'd say we're not quite there, but not light years off the former, so itchy trigger fingers. In conclusion, an attempt at 3 answers. Should you bother owning anything other than stocks? Yes. You may like to think you're a long-term investor, but most people's horizons will become dramatically shortened in times of equity market stress. And in those times, you will be acutely grateful for any relief asset class diversification can bring. There's a good chance it will stop you doing something stupid, even if, in theory and over grand history, it is a drag on returns. And this is particularly true if you're using leverage. Should you bother owning anything other than US stocks? Yes. If you are 100% US within your equity allocation, you are taking a massive sector bet. You are full speed ahead on the tech will save the world narrative, and you're not looking back. Forget hard or soft landing for the economy. The current US valuation premium is pricing in an immaculate landing for the AI near-term productivity miracle story. Should you bother trying to time stocks? Yes, but I'm most hesitant about market timing. Set and forget has a wisdom to it. But I'm of the view that there can be times where extremes are so apparent that the old trope of time in the market, not timing the market, is lazy. And this note is, after all, against apathy.
If you enjoy the show, be sure to leave us a rating and a review on your favorite platform. You can read investment research like you heard today by subscribing to the Idea Farm's free weekly e-newsletter at theideafarm.com. Thanks for listening, friends, and good investing.